Right, so to have another sample problem here, this time for direct labor. So I believe this problem just provides a complication in that the student is required to work back from the provided or the given information, right? So Company A is a manufacturing firm that uses a standard cost system. The following information pertains to direct labor for product A for the month of November. Standard rate per hour, 12 pesos. Standard hours allowed for actual production, 3,000 hours. Actual rate per hour, 12.6 pesos. Labor efficiency variance, unfavorable, 2,400 pesos. Total units from actual production, 1,500 pesos. What is required for us is actual hours worked and the standard time required for each unit of product, right? So in answering problems, I would suggest that the student focus first on what is the required. So for this particular problem, there are two aspects which are required. First is the actual hours worked and the standard time required for each unit of product. Now, personally, if I would look at this problem and I see the standard time required for each unit of product, given the information provided above, I can conclude that the second requirement is much more straightforward to arrive at versus the first one, because the standard time required for each unit of product would actually only be to divide standard hours allowed for actual production, 3,000 hours, divided by the actual total units produced during production, which is 1,500, right? So 3,000 divided by 1,500 would give us the standard time required for each unit of product of 2 hours, right? So that's basically our answer already for the second requirement. All right. So for the first requirement, actual hours worked, we just have to perform a work back analysis here. All right, here you go. So just to break this solution down into its components again, as we already discussed, the second requirement is much simpler than the first, wherein we divide the total hours over the total units from actual production of 1,500, gives us 2 hours per unit. Okay, so that's done. However, for the first requirement, we are to compute for the actual hours worked, right? So to arrive at the total actual hours worked, the problem gives us a labor efficiency variance of unfavorable 2,400, as well as our rates, right? So we have 12 and 12.6 as our rates. However, we would only be able to make use of the standard rate. All right. So as discussed earlier, the efficiency variance, if we can remember here, the efficiency variance might as well be computed as standard price, right, multiplied by the difference in the quantity, or the hours, as our current problem is on direct labor. All right, so difference in hours, okay, multiplied by the standard rate would lead to an efficiency, quantity, or usage variance, right? So in the problem, as you can notice, what is given is actually the usage or efficiency variance. We also have been given the actual price, the standard price or rate. We have also been given the standard quantity, right? So we should be able to work back to compute for the actual quantity, which is the requirement of the problem, right? So let's just go back to the problem slide. Here you go. So we mentioned earlier we should make use of standard hours. Okay, we are also given hours, standard rate per hour, 12 pesos. We're also given here our standard hours allowed for actual production, 3,000 hours. Then we are also given here our 2,400 unfavorable efficiency variance. So Given these items, we would now be able to work back to compute for the actual hours worked. Okay. So in computing for the total actual hours worked, we compute first the difference in time, which caused the unfavorable efficiency variance of 2,400. All right. So efficiency variance is equal to difference in time times the standard rate. Given that the efficiency is 2,400 unfavorable, this is equal to the difference in time multiplied by 12 pesos as standard rate. And then if we transpose the 12 pesos to the other side, and then we get the difference in time as the requirement, we arrive at 200 hours unfavorable variance. Right? So remember guys, hours, because we are trying to work back for the actual hours. We arrive at the standard time of 3,000 hours, and then we add the unfavorable difference in time of 200 hours, and then all in all we get 3,200 hours as the actual hours worked. Okay, so that's that. Just to provide a recap on this one, if we go back to our visual diagrams here, we can see that it's very simple. The approach is very simple in that we would just be trying to compute for the variances from top to bottom. Very straightforward. However, in the problems you might be encountering, there might be elements in this sort of diagram that may be missing, which are being required by the problem. So for those problems, you would be trying to analyze them further and break them down into its components and try to work back to arrive at the requirement, right? Alright, so to proceed to the discussion, still on the computation of the variances, we go now to fixed factory overhead. Right, so fixed factory overhead, the first step here is much similar to the direct material and the direct labor. We just deduct actual from the standard fixed factory overhead. Then, of course, we would now be getting the total fixed factory overhead variance. However, if you would like to break this down to its components as well, similar with the first three items, we insert here as a middle figure the budgeted fixed overhead, which is based on normal capacity. So when we say budgeted fixed overhead, normal capacity multiplied by the standard rate, right? And then standard fixed overhead here is based on the standard hours, okay? And if this is multiplied by actual production, this is based on standard hours per unit multiplied by actual production, which would lead us to the standard hours base on which to apply the fixed overhead to production. That would be multiplied by the standard rate as well, right? So if we get the difference between the first and the second, or the middle figure here, we arrive at the fixed spending or budget variance. Then if we get the difference between budgeted and standard, we arrive at the volume or the capacity variance. And then similar analysis here, if you get the sum of the two variances, we arrive at the total fixed overhead variance. Alright, so just to provide a simple example here, we have actual fixed 10,000, we have standard fixed of 9,000, and then we have budgeted fixed of 12,000. So if we get the difference between 10,000 and 12,000, we arrive at the fixed spending or budget variance of 2,000 favorable, right? And then if we get the difference between budgeted fixed and standard fixed, we arrive at the volume or capacity variance of 3,000 unfavorable. Okay? And then lastly, if we combine the two variances, we arrive at the total variance of 1,000 pesos unfavorable. Right? So similarly, we have a total unfavorable variance on the right side arising from volume, which is much greater than the total fixed spending or budget variance of 2,000 here, favorable, which leads us to a netting effect and nets to an unfavorable variance of 1,000 pesos. Okay. So just a few notes regarding fixed factory overhead. First here, the amount of standard fixed factory overhead applied to actual production is equal to actual production multiplied by standard time allowed per unit. multiplied by the fixed overhead application rate. So basically, that would pertain to our standard fixed overhead here, right? So in the problems you might encounter in the future, you might be able to arrive at the standard fixed overhead by using this formula. All right. Now, if the problem is silent, we can have the assumption that actual fixed overhead is equal to budgeted fixed overhead. All right. So that is if you've already exhausted all of the possible, given in the problem, or that you've already been able to, read through the problem and analyze, and in the end, you won't be able to arrive at either the actual or the budgeted, but the problem asks for the volume variance. That is when you can actually assume that the actual is equal to the budgeted, right? So in that case, you won't have any fixed spending variance. Okay. Next, we have just a few notes here regarding volume variance. So volume variance will exist if actual production is not equal to the predetermined activity level. Okay, so when we say predetermined activity level, we're actually pertaining to the normal capacity of the plant. Okay, so in most cases, this is already given as a capacity data. Like for example, normal or budgeted activity level or plant capacity is at 10,000 units, whereas actual production is only at 9,000 units. So in that sense, if the plant has a capacity of 10,000 but only produce 9,000, it is underabsorbed or underutilized capacity of 1,000, which will lead to an unfavorable variance overall. All right. Now, since the predetermined activity level is only a budgeted amount, it still provides for normal downtime in the plant or in the manufacturing line. It can still have some sort of allowance of overabsorption or overutilization, right? So in the case where actual production is over and above the predetermined budgeted activity level, the company may have an overabsorbed or favorable variance, or also known as overutilized capacity, right? Next, volume variance is not affected by production inputs because it is based and computed on produced output versus budgeted, right? So if we go back here in the previous slides, we can notice that volume or capacity is the difference between budget and standard, right? And then based on our formulas here, we're actually already basing these on the normal capacity, meaning the output, as well as on the standard hours per unit of actual production, right? So in that sense, we are looking at the output of the plant or of the manufacturing line and no longer into the manufacturing inputs. Okay, so in that sense, it is not affected by production inputs, right? And then similarly, it is the least controllable by the production supervisor, because the production supervisor normally only has control over the production inputs such as direct material, direct labor, and variable factory overhead. And then lastly here, it is volume variance is the most useful variance in evaluating plant utilization. As we've discussed here in the first bullet, depending on what is the volume variance produced by the company at year end or at period end, we would have a basis of determining whether or not the predetermined budgeted activity level of the plant has been utilized most effectively.